the U.S. economy is kind of like a super tanker. You just can't turn it on a dime. So what is going on is that we have a slowdown. Okay, the super tanker is slowing down.
Welcome to Wealthion. In a moment, we are going to bring you a fantastic conversation I had with Lakshman Achuthan, co-founder of the Economic Cycle Research Institute. He shares what their models are saying about the economy, inflation, and what investors might be getting wrong. First, though, we'd like you to take a quick minute and check out a poll we are conducting so that we can find out what's on your mind and figure out how we can tailor our content to best help you. Just click on the link in the description below. We can't wait to hear from you. Hello, welcome to Wealthion. I'm Maggie Lake, and today I'm joined by Lakshman Achuthan, co-founder of the Economic Cycle Research Institute. Hi, it's great to have you with us.
Good morning. Very good to be with you.
So it has been, I think, fair to say, a volatile start to the year, and I think many of us are opening those Q1 portfolio statements, and we're not really thrilled with what we're seeing. So I'd love for you, Lakshman, to sort of level set for us and maybe help us separate the noise from what investors really should be focused on as we, sort of move into another quarter and another part of the year. And let's start with the U.S. economy, because it seems like we're getting a lot of mixed signals. What are you seeing? Is the U.S. headed toward recession?
Yeah, and we've seen a lot of the R word in the headlines recently, and so great question to kind of get out of the way. So just to be for fun, I'm going to say yes and no.
I had a feeling you might say that.
Well, I don't, I certainly do not want to be, I want to be, I'm not sure if this is PC, but I want to be a one-armed economist. I want to give you the one, I don't want to do on the other hand. But the truth is we're going to have another recession at some point. We always do. And the helpful piece of information is that going to come sooner or later? And from everything I'm looking at, it doesn't look to be imminent. There doesn't look to be anything that is imminent in terms of a recession. Now, let's just clarify what a recession is. It's when output, income, employment, and sales all fall. They all have negative growth rates. The levels of those different activities are all falling. That's a recession. Is that going to happen anytime soon? Doesn't look like it. Okay. What's the main reason for it, even though all these crazy things are happening? Well, it's that the U.S. economy is kind of like a super tanker. You just can't turn it on a dime. It doesn't spin around like a jet ski, right? It takes this long, laborious turn. Okay. So what is going on is that we have a slowdown. Okay. The super tanker is slowing down. It's what we call a growth rate cycle slowdown instead of a business cycle slowdown, which is a recession. So the growth rate cycle slowdown is what we're all feeling when we look around and we anecdotally see things where we say, oh, the coffee shop line is shorter, or something else happened that I saw that seems like quiet, or maybe that means that there's something. Well, yeah, there's a little bit of slowdown, and that's what's happening. It's actually something that's been in the cards for a little while. As the composition of what's driving the overall economy is shifting. For many years, it has been the services sector with a little bit of oomph from the construction sector that has been moving the overall economy along. And now that part is easing a tiny bit, while the manufacturing sector, which had been totally on its back, not doing very well for a couple of years, is now starting to get some traction and move to the upside. And all of those things began shifting many months ago. It's not something recent. I think it's just we're becoming more aware of it now. And then in conjunction with headlines, you immediately take one thing and link it right away to the other thing and say, aha, I know what's going on. But I don't think it's that direct of a link, at least in the short term.
So why is the composition of growth changing? What's causing that shift, sort of pulling services down a little bit, pushing manufacturing up?
Yeah. Well, one thing is and the economy is not a market, obviously. There's very different things. The real economy is very different than a share price or an interest rate or a commodity price. But in the real economy, the services sector in particular, where most of us work, almost all Americans work in services of some sort, that had been punching above its weight in terms of jobs creation for years post-COVID. Now, I know COVID is ancient history. Right? We don't want to think about it, but what it did was it really messed up or changed very fast the composition of our labor force, put a lot of demand on education, healthcare, and took a whole bunch of people who were working out of the workforce permanently. And then we had some immigration stuff that slowed down legal immigration. So all of that made for a very tight labor market, in particular in services where, boom, they had a lot of jobs growth and nobody wanted to fire anyone. Typically, if the economy slows a little bit, employers say, oh, I'm going to let somebody go. Now all they do is they reduce the hours. They hang on to you. And so-called labor hoarding, and you might remember that term from a year or two ago. That's underneath all of this. The end result is that the services sector growth in jobs was running at almost 3-decade highs for several years. Now that's revving very hot. And all we've done is that's come off of the red line and it's come back down into a more normal growth rate. That's what's happened. Okay. From 3 or 4% growth down to like 2% growth, something like that. So we feel that in the job statistics. At the same time, or slightly after, not exactly at the same time, a little bit later, you have the manufacturing sector start to get some growth. And that is really because of the global industrial cycle turning up. And that's, to oversimplify it, all of us around the world, none of us really manufacture anything completely on our own. We all have a piece of it, and either we're an early stage component or a mid stage component or a final stage component. There's a world's factory floor largely. And when the global industrial cycle begins to move, it's reasonably synchronized. It's the only global cycle that really holds up over time in what we've looked at, and we've looked at it for decades. So we have a global industrial growth cycle upturn, which the U.S. is participating in. And that gets us some jobs growth. You see a little bit of jobs growth. If you look at the last reports, you see manufacturing's adding jobs. The difficulty is that most people don't work in manufacturing. Most people work in services. So in the aggregate level, it's not going to completely offset. It's only going to mitigate it a little bit. The one other thing I'll toss in here before we answer more questions is that the manufacturing cycle is a bigger cycle. It has bigger amplitudes in it than services, which is smoother. So services is kind of taking this easing slowdown. Manufacturing is turning up, but it tends to turn up a little sharper. And so we could look forward to getting a little more activity than expected out of manufacturing.
That's so interesting. So there's a lot to unpack there, but I'm going to start from the most recent comment you just said. The global, the turn up in the manufacturing, the global manufacturing cycle, does that bode well? Is that a positive indicator for the global economy?
It is. Well, yeah. Now the wind is at your back instead of being in your face, right? But again, it depends. So the short answer again is yes, and then it depends on your local economy. So when we look at global markets, one of the things that is really there's a global price is any of these industrial commodities. Okay, so now does that mean industrial commodities prices are going to go up? Maybe, probably. But the difficulty is, and what our analysis doesn't really provide is what's happening on the supply side. Right. So if everything was perfectly static and hadn't changed, and you have a global industrial upturn, oil prices are they're probably going to rise because the demand, relatively speaking, is going up, or some other metals or industrial inputs. But if there was, say, a cartel that could decide when to produce more supply,
Suppose there was.
suppose there was, then that could mess with it a little bit. And it works both ways, right? You could also have a strike in a mine or something like that. And if that combines with more demand, boom, you really get a move. But backing away from any commodity specific issue, the big shift, which I think is ultimately going to manifest in commodity price inflation, industrial commodity price inflation, is that demand is cycling to the upside. And so that helps.
Right. It's interesting you mentioned inflation. I think that's really important. But so if we're in this sort of where at least the demand side is a little bit clearer, because that's also been murky, right? So there have been supply issues and there have been demand issues, and that's caused a lot of price swings. And it's been hard to kind of chart the course. A lot of people talking about the fact that we've been in this fog because it's hard to see both sides of the equation. If we're getting a little clarity on the demand side of the equation, one of the really persistent themes that I'm hearing from people right now is the end of U.S. exceptionalism, right? The end of the U.S. as the sort of engine of growth for the economy, and that positive economic story shifting elsewhere. And of course, the knock-on advice on that is reduce your exposure to U.S., go all in on international markets. The story you're telling sounds a little bit more nuanced to me, that yes, global manufacturing's turning up, but it's not like the U.S. is careening into some sort of sharp downturn.
I'd agree. Yes. And when we look at the relative strength now, let me put global industrial growth on hold just for a moment and just talk about overall economic strength, say for the U.S., Europe, Asia, and then we'll talk about China as a separate issue. The U.S. looks pretty good. It's not like we're horrible against Europe or Japan, for example. I think we look totally competitive and pretty good on growth, but it's slowing from really, really good to pretty good. So back in December of 2024, we were calling the U.S. kind of Goldilocks. You had really good growth and inflation pressures, while sticky had been shifting a little lower. It's about as good as it gets.
Yeah.
And you saw the markets price it pretty quick, right? And then here we've got, well, no, inflation's still sticky and our growth is slowing. And so therefore, now we have to, it's not so exceptional globally. Meanwhile, Europe had been beaten down like crazy, right? I mean, both in terms of talking about its economy and its markets. And while they have a lot of issues structurally, they do have an old, very big industrial base. I mean, they've been making things for a long time. In some countries, they're particularly good industrialists. They're having to retool for the new economy and so on and so forth. Germany, but France is a big industrial place. Italy's a big industrial place. And they're going to benefit from a global industrial upturn. And so if you're a value investor, those that are left, they're going to go hunting and start looking for stuff. And I think you see some of that happening. Now, there's another nuance. I said put China on the side for a moment. I want to bring it back. Our initial call of a global industrial upturn from the end of last year, and this is, again, the super tanker stuff. It takes a minute for it to turn. So it's not like it's over. None of this is over. We're in the midst of this. So as the global industrial upturn is getting a grip, it starts actually without China, which is remarkable because China is about a third of global manufacturing capacity.
Yeah.
Right. But it begins without it. And China structurally, now I'm looking at it over what is their intentions over many years. They don't want to be a manufacturing floor anymore. They did that. The policy is to really shift away from that to domestic consumption and services. But beggars can't be choosers, right? When you're in a lot of trouble, and they have a lot of trouble. They've got a housing issue and some other issues with debt that they're dealing with. They may have to go back to what works, whether it's a policy or not. And so if global industrial growth is going up, Chinese exports are going to participate. They're going to start to get dragged into it. They have been dragged into it. Now you have China joining the global industrial upturn, which I think makes the case a bit stronger, is all I would say. I don't want to make it too, but I think that to me, it's the final piece of a puzzle there, which comes in.
So it's interesting. If China does join in, does that change the inflation scenario for you? Because there was a time when China exported a lot of deflation to the rest of the world. It sort of, kept prices down. How are you thinking? Maybe let's take a step back before you answer the China influence. How are you thinking about in the inflationary environment? So if we've got a global economy that's sort of going to get some lift from manufacturing, and China's just beginning to participate in that, what does that mean for the inflationary outlook for the world economy? And then we'll talk about some specific challenges that countries might face.
Right. There's a lot in there. I'm just thinking.
I know, like how to separate it all out. The Fed just said, let me be more specific. The Fed just said inflation's transitory again. And everyone was kind of like, did they really use that word again? Because we know what happened last time they talked about that. So I think there's a lot of skepticism, and I'm hearing people ask, certainly people who write in ask all the time, are we in a stagflationary environment? Are we going back to the 70s? Are we going to have this sort of persistently high inflation, which we know caused a lot of angst for a lot of people and voters, and they just do not want these high prices. So there's a lot of, I think, skepticism and fear that we're in this inflationary environment, and policymakers are not addressing it.
Yeah, I think that's probably healthy to feel that way and to be a little skeptical and to be questioning of policymakers and both the Fed and Washington. Before I even get into it, look, everybody I think is trying their best, right? I just want to say that to begin with, whatever they think is the best thing to do. Now, when you look at cycles, I just have to take one more step back before I get into this. When you look at cycles, there's cycles in growth and there's cycles in inflation. Those are two different things. They do not equate together. That's a huge difference in the way that ECRI looks at the world compared to Wall Street, for example, which are using very nice, very good models that extrapolate things and literally link inflation and growth together in the algorithms. Now, we do not do that. What we do is we believe that it's pretty complicated, the market economy. And a part of the reason it's pretty complicated is because we're all involved, all human beings, which are very driven by fear and greed, basically. We're not that rational at the end. I mean, maybe ultimately, but we have a lot of knee-jerk reactions. And as a result, very hard to model in an algorithm. So rather, we observe that growth and inflation are cyclical. There are certain patterns that present themselves at the cycle turns, not necessarily in between. So our approach of looking at it is very different than a model builder's. And when we're looking at those patterns to recognize at the peaks and the troughs in a cycle of growth or separately inflation, we have these leading indexes. And so now I'm getting to what is this future inflation gauge? The future inflation gauge is an indicator that we use for decades now to forecast turning points in the inflation cycle. It came into prominence, and we have them for 11 countries around the world, plus a couple of emerging markets. So we have a pretty good global picture on the direction of inflation for the major markets. But let's stick with the US to keep it simple. This indicator came into, I guess, on people's radar screen because Greenspan was a student of my mentor, Jeffrey Moore. And in the 1990s, in the middle of the 90s, there was a really weird Fed moment where they hiked rates in early 94, caught everybody off sides, and a bunch of stuff blew up. It was a preemptive move on inflation. So now this relates to Powell and transitory. Okay, so here you have Greenspan, and this is Greenspan circa 1990s. I am not ascribing this to Greenspan in other decades, okay? But Greenspan circa 1990s was preemptive. In 94, he hiked. In 95, he eased. And that is suspiciously around a very long expansion and some good growth without a lot of inflation. Okay, and there's been a lot of stories written about that, but I know that happened, right? And he linked it to this future inflation gauge, Greenspan did. Now, the directional move on the FIG now. So I've just given you some credibility for the FIG, but now I want to talk about what's it saying today.
Mm-hmm.
The thing came down really hard in 23 into 24, and then flattened out like a pancake. It's kind of weird. I just have to tell you, I've been watching this thing my entire professional life. It doesn't really come down and go flat. It doesn't happen. There's a lot of stuff going on that is pushing it to the upside and pushing it back down. And so what the FIG has done is it's been in this flat range now for, and dare I say sticky, I'm so sorry, but we've been saying this for a long time. It's been in this flat range for well over a year. At the end of last year, it started to ease, and then now it's popped back up. So what we were hopeful that it was starting to ease into a more persistent Goldilocks, but things happened, and now it's moving up. Part of what's helping the FIG up is some commodity price inflation, but it has exposure to all kinds of bottlenecks in the system. It has exposure to exchange rate stuff and credit stuff, and these are all key drivers of the inflation cycle. And the mix of them is telling us that I couldn't say what Powell said, that it's transitory based on the FIG. So let me kind of tie those two together there. I don't want to predict the predictors. I'm trying as best as I can to kind of share with you the story of the predictors. And it started to get a little softer, and now it's popped back up. It's staying sticky. And I don't know exactly where it's going to go from here. I have suspicions, but I don't know.
That's problematic for folks who believe that, and the Fed, the market's pricing in Fed easing. So that's a problem if you want interest rates to go lower. Scott Bessent's talked about wanting them lower.
Yeah, this is, we've seen this movie before. You go back a little over a year, and I think the market went to 6 or 7 cuts in 2024. Didn't happen, right? So, and it works the other way. By the way, the Fed was hiking in 2018, and the FIG was not going up. And we were like, yeah, they're not. That doesn't look good. And the market fell 20% in December 2018, and they backed off. You had the first Powell pivot. So I do think the Fed is trying to do the best it can, but I don't want to bore everybody with this, but if you dig into what they actually say and what they say they're going to do, they do these whole studies on how are we forecasting inflation. They did one a couple of years ago, and they concluded we're not going to even try.
Yeah.
Okay, we're going to give up. Now, that's a problem if the environment you live in is cyclical. If you think about it, your engineers on the call here, you don't even have to be an engineer. Just think about it for a second. You have a cycle, it's going up and down, let's say in inflation and the economy. You could watch them both. And your job is to, as the Fed it's like stable growth and inflation, right? They have 2 mandates. So let's not let jobs tank, and let's not let inflation go crazy either way, up or down. And if your tool is primarily interest rates that work with a long and variable lag, you can't wait until the cycle moves and then say, oh, now I'm going to do something. Because that means if something's accelerating to the upside and then you stomp on the brakes, you're going to get these jerky moves, which is more amplitude in your cycle instead of less amplitude in your cycle. So I find it kind of, I don't know what the right word is. I think they can do better. in anticipating inflation.
Yeah. Well, it sounds like they need to do better because otherwise
Yeah.
they're going to create volatility when they're trying to damp it down. Is the bond market so the Fed maybe needs to do a better job. Do you think the bond market's been adequately pricing that? I mentioned that they're pricing in Fed easings, but you've seen those yields staying above 4%, keep backing back up toward 5% at moments again, because they seem to be sniffing out something about inflation and being skeptical that it's going to go down. Do you feel like the bond market seems adequately priced or at least on the
Yeah.
right theme for inflation?
For now, yeah, it's your mix of growth and inflation, which is going to hit the long end, and I think it's adequately. I mean, I wouldn't have too much of an issue with it. I have spent years waiting for bond market vigilantes to show back up, and they don't. So I'm not going to hold my breath here. Maybe they will now, but I will continue to watch the fig. If the fig made a sharp move up,
Hmm.
then I would expect some real fireworks. But that has not happened yet.
Hmm.
Um, and so, but there's some vulnerabilities. If for any reason the dollar got a lot weaker, or if commodity price inflation started to move, or if the economy didn't weaken as much as people expect, which is kind of our call, those are all things that are a little tighter. But I don't want to predict the predictors. Like, I know these things, I'm watching these cycles in growth, but I want to wait and see what the fig says. I do not want to predict the predictors.
Yeah.
I don't think I know more.
It's important for people listening to be aware of that though, because there are a lot of people that maybe don't have hedges on for inflation in their portfolio or that are exposed in a way that if we do see growth and inflation running hotter and higher, they're kind of not ready for that because they've been positioning for something that where we're in a falling rate environment.
Yeah, and I think it's part of it might even just be sheer boredom. You've been sticky for so long, you want to make a bet one way or the other. But I think the correct call at the moment is more sticky.
Mm.
I think the more solid kind of game changer for 2025 is global industrial growth upturn. That seems to be the thing that's the clearest in our indicators, and no imminent recession. That can change. We'll check in 6 months. That I could be saying something different if the leading indicators deteriorate on growth. But the key thing is this murkiness. I agree. I don't know what's going to happen with geopolitics. I don't have a particular insight with that, and I think we're all suffering from that. And so what I'm doing is sticking with the tried and true indicators. Look, these indicators, to be clear, some of them have been around over a century. I mean, they've been running real time since the 50s or 60s, 1950s or 60s. But we can do an out of sample, I mean, an in sample, but not fitted look all the way back to the early 1900s, which is important because some of that predates the Fed. Let's say the Fed was out of it or something. You had depressions, you had panics, you had all kinds of weird stuff. You had all that crazy tariff stuff happened. It's all in there. You had big shocks, right? So like Pearl Harbor, or some bank failure, or the '87 crash. And how do the indicators perform through some of those admittedly shocking moments? So here we have a 10% decline, 10% something decline. I don't know exactly what it is. It's in that neighborhood. And what does that mean? Well, I could tell you that during growth rate cycle slowdowns, especially in the QT kind of era, post GFC, 10% corrections are concentrated during those growth rate cycle slowdowns. They tend to not persist too much. And now I'm going back many years, because there's a reaction function of some sort that comes out of either Washington or the Fed. And while it was a little more subtle this time, I think there was an adjustment with the QT stuff in the last meeting, right? And so that's a little reminiscent of what was happening big time post GFC.
Yeah. So it's interesting. I think that's a really important point to bring up, because it kind of feels right now like, it always feels like this is totally different, and chuck the
Mm-hmm.
models right out the
Mm-hmm.
window. So it's interesting to sort of understand that there is this sort of, decades long bulk of data that we should pay attention to, instead of just getting whipsawed by the news, right? That's what we sort of started out talking about. But how do you, if you're thinking about these models, these long view models, and the super tanker of an economy that takes a while to change, how do you think about the huge political moves that are happening? How do you make sense of that? And how do you figure out what their impact is? Because even though we've seen maybe tariffs in the past and we've seen geopolitical uncertainty in the past, I mean, the pace of what's coming out of Washington is incredible right now and kind of unprecedented. The nature of executive order is unprecedented. The fact that people are talking about maybe this is a changing world order where we're going from a move away from globalization to a multipolar world. That seems like it would be very different than what we've been in since the 50s. How do you take all of the in the moment things that are happening and to figure out how to make sense of it based on your modeling?
So first, I agree. These seismic changes may be happening, and perhaps we're switching into a new regime of sorts globally in terms of the economy and how it's organized. Um, that the impact of that, or the pace of that change, or what it means in the next quarter or two, makes its way into the leading indexes.
Mm.
So the the inputs that go into the leading indexes are hard data, market data, and soft data. And so those are we spend a lot of time figuring out what to watch and then how to put it together so that we're getting a clean signal. That's a lot of research that we do. And if sentiment tanks, or if something happens with real economy, or something happens with markets that's going to impact real data, that's going to impact the real economy, then that's going to filter in and impact our leading indexes and have us, we believe, usually looking the right way in terms of direction. I'd say a secondary issue is magnitude. It's not the strength of the indicators; it's more the direction of which way to look. And in a world like you were just describing, where it's not an America centric kind of global economy, but there's a multi-region kind of global economy. To my ear, that sounds like these cycle changes and differences are going to become more prominent, not less prominent. And one of the big insights from cycle research is that free market oriented economies have inherent cycles. So that even applies, say, to China, which has a lot of central command.
Mm.
But the majority of the activity, they're open enough to the global economy that they are having cycles. For India, when we were doing the work for India decades ago, before the 1990s, you didn't see the types of cycles that we use to make decisions. You saw a whole mess. It was very messy. But as the economy became liberalized, the sequences came into alignment in a way, and so we could at least make the directional changes. So I don't know. I certainly do not know everything. I just know that directionally speaking, there's not a recessionary trapdoor right in front of us, and we're slowing down. Inflation is going to stay sticky. Compared to the rest of the world, we're not horrible. We're just slowing from being very, very good. And there may come a time when the current type of uncertainty with the headlines becomes recessionary. It's just not today.
Mm.
If the cycle indicators, the way that you get a recession is that the cycle indicators cycle down hard enough that the way we describe it, a window of vulnerability opens up on the economy, within which bad stuff can be exceptionally painful. When the window of vulnerability is closed, you could have a whole storm going on and the economy can cruise through it. And so the change in effect is when these forward-looking drivers, if they move down strong enough that a window of vulnerability opens up, the same thing that happened 6 months ago that wasn't recessionary could be recessionary now. Again, this is going into the academia of forecasting of recessions, but a lot of times they'll end up on, the recession was caused by a shock. Okay, and if you think back about recessions, there's a story about a shock that was there that was associated with the recession. Actually, there's shocks are happening all the time. It's just which are the recessionary shocks, and the way that you can see when a shock is going to be recessionary is when the window of vulnerability opens up.
That's a fantastic way to look at it because we can visualize that. And I
Yeah.
think we all can feel that too. You just
Yeah.
get a little bit yourself, right? You get a little
Yeah.
more uneasy. You're not sure about your job. You feel like you want to be a little more conservative because you feel vulnerable to something happening. And then, of course, Murphy's Law usually when something happens. You don't see, it does not feel like the U.S. is in a vulnerable, the economy is in one of those vulnerable states right now.
Not today, not while we're talking.
Is there anywhere in the world that looks vulnerable?
I wouldn't call out anybody. I think it feels more like troughing stuff than peaking stuff for the time being. And that, I mean, I'm not a politician, but maybe, hey, when everything's going great is when you do the weird stuff. And because you can get away with it. I don't know.
That would suggest
certainly
that they have a plan. I don't know. I don't know. Actually, it would suggest like a lot of. I always laugh because it's like, yes, you're right, but is that what's happening anywhere? I'm not really sure because it seems kind of reactionary in a lot of places in the world.
It does. I mean, I'm trying to tie. I know the audience is very interested in the markets, and I would just say that during growth rate cycle slowdowns, you can have corrections. It's not unusual. It doesn't mean there's a recession. Empirically, when we look over growth rate cycle slowdowns since the GFC, going back to 07, 09, they've been short. Like they haven't persisted. And in retrospect, you might say, oh, there was a policy reaction. There's a lot of liquidity. There was a lot of something that happened to help it out. So we didn't see them persist. Before GFC, during a growth rate cycle slowdown, you would see the correction persist a while, even though it wasn't a bear market. Bear markets are typically associated with recession.
I think you raised an interesting question, which people are asking, is that, are we in a situation where, whether it's a politician or a monetary authority, that we're not allowed to have recessions, or they're unpalatable, or, they cost you your job. And so they'll do whatever, even if it doesn't seem fiscally wise, to prevent any kind of recession. Does it feel like we're in a world where there are no such things as recessions anymore?
Well, no. My whole work is that's not going to happen. We're going to still have recessions. And I'm not saying that. I'm saying that based on the U.S. and international markets. U.S. for over 100 and something years, and international markets for at least 60 years, looking at the market-oriented economy. So based on that experience, I would say, no, we're still going to have recessions. But what is interesting, what caught my ear when you were saying that, is that it's after the GFC, all of a sudden a recession, which is a feature, it's not a bug, okay? This is a feature of a free market-oriented economy. It's literally you need them, okay? After the GFC, the policy conclusion seemed to be that a recession was Armageddon, and that this was somehow a bug that you had to get rid of. And I think that's a real fundamental kind of question to be thought through, because while there's a lot of collateral damage around recessions, and I do not wish that on anyone, in the system we have, the excesses that are just not healthy for an economy to grow on a sustained basis get kind of pruned during recession. And it sets you up for healthier growth. And by healthier growth, you could say stuff that gets into the middle class or lower wage earners as well. I mean, you could look at it that way. These boom busts that we had, so we used to have jungle variety recessions, right? And now we've had garden variety recessions for most of our experience. And then we ran into the GFC and we were like, oh my God, that's so horrible. How could that happen? We're never going to have one again. Well, that's not the way it works, right? I mean, we used to have these jungle variety recessions. They were actually pretty normal. And as we moved away from an industrial economy to a service-oriented economy and non-discretionary services, it got smoother. There's a lot of automatic stabilizers that went in. So it used to be when you lost your job, you didn't have any money. Now, I'm not saying unemployment insurance is a lot to live on, but it's something. It's not zero, right? So these types of stabilizers take off the lows. But then here we are. We've taken on a lot of debt.
Yeah.
Post GFC, in the view that recessions are Armageddon, and all of that debt it kind of limits us now.
And why am I thinking of AI and all of the VC money chasing AI when you're talking about these sort of boom? When you take away the recession and you're not sort of forcing some discipline on capital, do you worry that it feeds? Is that what feeds something like a bubble? And I'm not suggesting AI is, but this is the question haunting everyone: is are we in the beginning of a bursting of a bubble because there's no consequence to that?
Yeah, that was certainly a feature in the dot-com bubble. There was the so-called Greenspan put after '87. There was this feeling that you could get out over your skis and you would be too big to fail. You'd get bailed out. And we've all seen those stories, right? Mm-hmm. And the feeding at the government does something special for some little slice of the business. And that is a slippery slope because it's that relationship between risk and return. You need the risk part to really allocate properly. And if you remove the risk, then you could be a little bit more flippant in how you allocate your capital. So that, I think that is probably something to think about.
How are you thinking about AI from a productivity point of view? Because productivity is the miracle, right? It's the non-inflationary, the miracle that helps you get non-inflationary growth. But we kind of, we're at the beginning of this. Are you plugging that into your models? How are you thinking about productivity?
Well, we think about it a lot for all the reasons you just mentioned. And it does work its way. It is captured by our leading indexes. The problem is it's really hard to measure. And it's extremely hard to forecast. I don't even know if productivity growth is forecastable. We can opine about it and say, isn't it obvious that I could do this thing with ChatGPT and I could do whatever and I'm faster, or I could do a machine learning and it'll optimize something? Okay. And that may, in fact, even make you and me and listeners more productive. I'm not saying it doesn't.
Right.
But does it make the U.S. workforce or the global workforce writ large more productive? That's unclear. And it certainly doesn't do it quickly. One of the things I would point out is that for something like services, very hard to measure productivity. Manufacturing, a little easier because you can kind of count things. And it's, we're pretty productive. We produce a hell of a lot with a lot less people. construction, we're not productive at all. It's like negative. It's really bad. And that's a decent sector of the economy.
Yeah. Why is that? Do we know why that is lagging so much? Because presumably it would have access to some of the same tools that.
Yeah.
Do we know why productivity is so poor in them?
I don't think we really know. Again, productivity is a tough one. You could say there's capital investment, which we don't do a great amount of. Okay, so we're horrible at capital investment. All our stuff is pretty old.
Yeah.
Relatively speaking. I mean, we're a young country, but it's still 100 years old.
That's a really good candidate for the
then there's education. Because you need the workforce for using some of these new information tools has to be educated to do so. Then there's I'm sorry, but I got to go back to COVID. It was a big deal what happened with the jobs market.
Yeah.
And you took. I'm not a construction guy. I've watched construction guys. Some of my friends are construction guys, but I just want to say I'm not a construction guy. But you could see there's a huge difference between somebody who's 50 and who's been building and has a wealth of experience and someone who's young.
Yeah, we lost a pipeline of a lot of critical workers.
And you get this huge hunk of serious knowledge that's just like, this is not worth it to me. I am checking out, and the young guys are coming in, and to make a choice to be a construction worker in today's economy, not a tip. There's a lot of people who go in different directions. I'm going to build an app. I'm going to do this and that, right? And so I don't know exactly what's going on. I think there's something in the training of the workforce, something, and then there's, of course, and I must say this, there's regulation. While I'm not inherently against regulation, all of these things are probably good in moderation.
Yeah.
Right. And so all of those things are in there.
Yeah.
And I don't know exactly which one you could pick.
I think it's probably a combination of all of them. It makes sense. Yeah. And by the way, whenever there is a very big problem, there's a very fantastic business opportunity. So anybody who's leaning into AI, there's the sector that you want to disrupt. I think that for young people, that might be the
100%.
Yeah, that's super interesting. So, Lakshman, as we close out, first of all, I think it's really important at the beginning that you made a distinction between the real economy and the markets, because there are two different things. And I think we've all been feeling, when I said it's been volatile, we feel bad, we're opening our portfolio. Part of that feeling is based on what's happening in the markets as opposed to the real economy. Do you worry that volatility in the markets can become something that impacts the real economy? How should we think about that? Or should we try to separate out when we're thinking about our investment lens?
It totally can. The longer this goes on, I think again, I don't want to predict the predictors, but I could imagine it weighing on the leading indexes, because the uncertainty means that you may hold off on a capital investment, which we probably need. So you're hesitant to take a bigger bet where you might see an opportunity, and you probably buy a little more insurance, that's costly. It's costly. So these are less productive kind of things over time. Now, again, a super tanker doesn't change on a dime, doesn't turn direction on a dime. But if you keep uncertainty and you hold back on investment for an extended period of time, I could certainly imagine it weighing on the leading indexes. But my process is to be as objective as I can be, and to wait to see it in the leading indexes. And let me just say that my general experience, I've been doing this since 1990, is that, the market rarely gets ahead of you. And even if it does a little bit, in the big picture, it doesn't matter in terms of decision making. And I'd much rather have some conviction in the direction I'm looking.
That makes a lot of sense, which is why we're separating out some of the noise that might come from the markets. Keep your eye a little bit on the fundamentals. We've had a lot of momentum trading. Is really in the driver's seat now. And I asked somebody about, the fundamentals. They said, well, that's fine. That's the fundamental story. But right now it's really hard to fight momentum.
Mm-hmm.
Again, like when we're looking at the markets, what is your advice to people as they're trying to figure out, do I jump on the train, or should I be fixed on the economic fundamentals and not lose sight of that? What is the relationship between those two things?
Look, I'm built more towards the economic fundamentals, the direction. So I'd say no recession, but I have to allow for corrections.
Mm-hmm.
So I can have exposure there, but with that knowledge.
Mm-hmm.
Inflation's sticky, so I need an inflation hedge. Okay. I'm not going to give up on that, and I'm glad I have it. It has served me well, right? Mm-hmm. And then finally, this global industrial growth thing, yeah, I'm happy to play along on that. That feels pretty good. It gives me something to do. Because sometimes you want to do something. You've had this inflation sticky the whole time. You're like, okay, I got that. You've got a little bit of exposure because there's no recession, but you have to be wary of corrections. So what else am I going to do? Where can I go along and get some more fun? And that may be in the global industrial growth upturn. That's where I would look.
I love that. And tariffs, should we be concerned about which
the
story changes every day?
Yeah, look, April 2nd's a big day. These are always, it seems to be, we just have to be resigned that you're going to just have more and more of these headlines. So therefore I tend myself to look more at the actions than the words. So I want to see what actually happens. And look, tariffs came on in 2018 and you had currency adjustments. And so we're having some currency. I think currencies are interesting. That's how
dollar devaluation, and some people think that's a policy objective.
Yeah. So then your inflation hedges can help you there if they're right, if they're the right ones. I mean, not for nothing, gold is up, right? So you can I think currencies will be interesting this year. That's another interesting spot in here because it can nullify in certain cases tariffs as it did in 2018. I'm certain the administration has learned from that, so they're going to try to navigate around that as best they can. So we'll see. There's been talk of a Mar-a-Lago Accord. What does that mean? Is it real? Isn't it real? I don't know. Right? We got to watch.
Right. And, currencies is not something that everyone watches like that.
No.
That's going to have to be something we insert into our framework, I think.
I really think so. And going back to what you said, if we're going from America defines the global economy to different regions make up the economy, boom, now we're back in currency land.
Lakshman, this was so fantastic. So wonderful to catch up with you and sort of get our feet firmly planted back in the fundamentals.
Thank you. It was a pleasure.
Thanks so much.
Bye-bye.